Good afternoon, everyone. My name is Alana Brown, and I'm here with you from solo401k.com and Neighbors Group. Today, we will be talking about the participant loan. So welcome. This is our new Wednesday webinar series. We are so excited to start doing this. We're going to have a new topic every single week. If there's anything you guys want to learn about, let us know. Post it to our network, solo401k.net. Shoot us an email, support@solo401k.com. Like always, let me know over here. Can you hear me? Can you see me? As we get started, I'll give you a little agenda. First, we're going to go through a slideshow. After the slideshow, I'll take you on the dashboard to show you where you can access your participant loan generator. As I'm going through everything, if you have any questions, ask them down here. We'll have plenty of time to address the questions that you have. Good afternoon. Hi, Mary, George, Eddie, Jim, Teresa. Awesome. So let's jump into the participant loan. Hi, Doug. Be your own bank with the participant loan. Quick little disclaimer, like always, we are your IRS plan document providers. We are not the replacement for your CPAs, your tax advisors, your legal counsel. We're here for support and education. That's me. I'm Alana Brown. So what is the participant loan? It's you taking a loan from your 401k funds. So you are the solo 401k plan participant. So you can take money from your 401k. Not all plans offer the participant loan. So if you're not a current client of ours, we can absolutely restate your plan and you'll be able to utilize this loan. So the participant loan is tax-free. It's a temporary withdrawal of your retirement funds. So you're not paying the withdrawal penalty. You do not need to add the loan amount to your taxable income. The maximum loan amount is 50% of your vested balance or $50,000, whichever is less. There is an exception. If you do have less than $10,000, you can take up to the $10,000 amount. If you already have an account with us, you could take that loan immediately. If you don't have an account with us yet, you could potentially get that loan within 5 to 8 days. So very fast process. So let's go over an example. So here's Nisha. Nisha has $150,000 in cash and then some other funds in investments. So total is $235,000. So you can see the breakdown. There's $50,000 in real estate, $35,000 in stocks and bonds, and that $150,000 in cash. So you add up all of that, and that comes out to $235,000. What's 50% of that? $117,500. That means Nisha can take the full $50,000. So as you can see, Nisha is taking the funds from the trust checking account or brokerage account, and it's going into the personal bank account. Let's look at another example. So this is Adam. Adam has $40,000 in cash and then $150,000 in private equities, but he cannot touch those funds for 7 to 10 years. So let's see how much Adam can take. So the total balance is the $190,000. So you would think, 50% of that is going to be, I'm not going to do math, but he could take the $50,000 if he had the $50,000 in cash. But because he only has the $40,000 in cash, he can only take the 40. So you need to have the actual cash to take the funds. His amount justifies him taking the 50, but because he only has $40,000 in cash, he can only take that loan for the $40,000. So a great aspect of the participant loan is that if your spouse is participating on your plan, they also can take out possibly $50,000 as well. So you each get your own participant loan. Let's take a look at Hector and Poochie. So they have plenty of funds. You could see, their rollovers, their contributions. All of this is in their 401k trust. You can see the breakdown of their funds. Their totals are well over that $100,000. So that means they can each take the $50,000 loan. So now, as a family, they're taking $100,000. If you have a joint bank account with your spouse, those funds can go directly into that joint bank account because they're both on that bank account. So what can you use the money for? You can use it for anything. That's what is so cool about the participant loan. Let's say, there is an investment out there that you want to get into, but you can't do it because, maybe it's an investment that's with your dad and that's a prohibited transaction. Maybe you need a new car for your business. You can't typically use 401k funds, but this allows you to take a loan from your 401k funds. Now it's your personal funds. Now you're going to do anything you want with that. Pay down debts, bills. So honestly, you can do whatever you want. The interest rate. So the IRS states the interest rate must be reasonable and cannot be more favorable than what the participant can get from a financial institution for a similarly secured loan. So the interest rate is going to be the prime rate plus 1%. So right now, the prime rate is 3.25%. So the participant loan is going to be 4.25%. I've had people ask, can I pay myself 20% as the interest rate? You cannot. Yes, it sounds great because you're getting some more funds into your 401k, but you want to follow this interest rate. We have the loan documents in your 401k. We also have that participant loan generator that I'm going to take you through. So we do all the paperwork for you. It's really awesome. So I can't wait to show you guys this after. Loan terms. So you have 5 years to pay the loan back. You have to make the payments at least quarterly. And every payment needs to have the interest and the principal. It's really, really important to be making these payments back. And you'll find out why here in a second. One exception to that 5-year rule is if the loan is going towards a primary residence. It actually extends to 15 years. This is only available for your primary resident. It is not for investment properties or second homes. So with the participant loan, it has to go into your personal account. A lot of people utilize this participant loan for their business. So you can't take your funds from your trust checking account or your brokerage account and put it into your business's account. It's got to first go to your personal account because you're the participant. From there, then you can move it out to whatever it needs to go to, whether it's your business account, to a friend, a child. But first, it's got to go to your own personal account. So same with paying the loan back. When you're paying it back, the funds have to flow the right way. So it's going to go from your personal account back to that trust checking account or brokerage account. Even if you lent the money to your father cannot pay the trust checking account back. He's going to pay your personal bank account first. And then from the personal bank account, it's going to go back to your trust checking account or brokerage account. This is really important. What happens if I make late payments? It may be considered a distribution. And the great thing about utilizing the participant loan is that you're not paying taxes. Typically when you take funds from your 401k, you might have a penalty to pay, as well as if it's, traditional funds, you're going to pay taxes on that. So this allows you to take out these funds with no consequences. But if you're going to make the payments late, they may be considered a distribution. So now you're paying the taxes. Also, if it's considered a distribution, it's no longer retirement funds. So you cannot roll it back in. It is now officially personal funds. So you do want to be very careful. Make your payments back. Same with if you default. It's considered a distribution. You're going to have to pay the taxes. It's no longer retirement funds. Of course, you want to work with your accountants for any kind of late payments or defaults. During COVID, there was an increase in the amount you can take out. It did jump up to $100,000. But just so you know, that has expired. We do still get questions about that, but we are back down to the $50,000 participant loan. So you guys all know that one of your roles in your solo 401k is you are the plan administrator. You're keeping those good documents. So you want to do that for this as well. You will have your bank statements that show that you're paying it back, but you do want to take notes every time you're making that loan repayment. We're a little bit more conservative over here at Neighbors Group. The more you're keeping good records, the better. If the IRS ever audits you, you have everything right there. Here's an example of the amortization schedule. And then also we have a repayment form. Can I have multiple loans? You can. What's most important is you're not exceeding that $50,000 or 50% of your balance. But there is some more math involved. So the second loan amount cannot exceed $50,000 minus the excess of the highest outstanding balance of all your loans during the 12-month period ending on the day before the new loan. For example, here's Jonas. Jonas has that $200,000 in cash. So he can technically take $50,000, but he's going to take $30,000. So he took that on March 1st. He used our participant loan calculator, figuring out his monthly payments. So now let's look at the calculation. So he wants to take another loan 8 months later. So takes a look at how much he's paid back. So far, he's paid off $4,448. We're going to subtract that from the original loan amount. So the outstanding loan balance is $25,552. So remember, he can take $50,000 because he has that $200,000 in cash. But he needs to calculate how much he can take out for loan 2. So he takes the highest possible loan amount, which is $50,000, minus that outstanding loan balance. So now for his second loan, he can take $24,448. So the law bases Jonas' maximum loan on all of his loans during that 12-month period. So if he was to pay that $25,552 back before applying for the second loan, he's still limited to the $20,000 for the second loan because he did the $50,000, paid off the $30,000, and now there's $20,000 left. So taking multiple loans can get a little complicated. You want to double check with your accountant. Make sure you're not taking out too much because that scary word, that distribution word may occur. So double check like always. Here's some common loan scenarios. So we have Madeline. She wants to flip a property, but she doesn't have enough money in her 401k and her personal funds. And remember, can't mix those. The property's listed for $150,000. Madeline has that much, but she's short for the rehab money. She needs about $45,000. Because after doing the math, there's a potential there to sell it for $230,000. So seems like a great deal. So if you see, there's the $195 total invested. She'll sell it for $230,000. So potentially a $35,000 profit. So what can she do? So she has $120,000 in cash in her 401k. So she's going to take that $50,000 because she's allowed to. She has excess of $100,000. So what she'll do, she'll take the loan, she'll send it to her personal bank account, and then move it off to the property. Now she's under contract and she sold the house. She made that money. Awesome. Her profits are back into her personal account. And then she's paying her participant loan back. You see some of her other profits, they're staying in her personal bank account. She can't put all of her profits back into the trust. She can only put back what she borrowed plus the interest. Another example, we have John. John and his daughter, Amelia. She needs to borrow $25,000, but John doesn't have the cash. However, he does have $80,000 in his solo 401k. So he can't just, wire funds from his 401k to his daughter because she is a disqualified person. So he's going to utilize the participant loan. So you can see the breakdown. He has $80,000. So he would be able to take $40,000, but he only needs the $25,000. So what is he going to do? He's going to send the funds, remember, to him personally, not to Amelia, to him, then off to Amelia. As soon as she pays him back, it's not going to go into the trust checking account directly. It's going to go back into John's personal account. Then he'll put it into his trust checking account. So now, first we're going to go on to the dashboard. And remember, if you guys have questions, post them down here. Okay, this probably looks familiar. It's your dashboard. So this is where you can take your loan out. You'll just click loan. Bear with me. Okay, so you're going to click loan, and here we are. We have a video that explains how to do it. And then we also have this calculator. It's fun to play with. You can see what your monthly payments are going to be. You'll just put the loan amount in, for how long. So this will populate the participant and the social, and you'll put in your amount and your loan terms. So what will pop up is your participant loan generator. So this will have all the information. Everything about it, your loan repayment, the evidence of the loan, security for the loan. All your supporting documents are here, as well as, how much you're taking, your interest rate, what needs to be repaid. So all you have to do this is, to use the loan participant, the generator, print it out, sign this. This is how you're going to take it into effect. Remember, you're the plan administrator, sign there. You're the participant, sign there. The promissory note is included. And you'll be doing all of the signatures. And then we also include the amortization schedule. So everything's here. All you have to do is generate your documents, sign it, take it into effect. And then you'll just simply write yourself a check from either your brokerage account or your trust checking account to you personally. So fairly easy. I'll give you guys a few minutes. Let me know if you have any questions. Oh, I see some questions. So we do have a question from Chuck. So basically, you'll need to have the cash sitting in your 401k to get the loan. Yes. If you want to take out, a $20,000 loan, you need to have that $20,000. The rest of it can be invested in your stocks, any deals that you have, but the amount that you want to take needs to be in cash. So good question, Chuck. Marianne, she asks, what happens if you pay off the loan early? Great, just document it. Just know if you need to take an additional loan, you still have to do that calculation. If it's beyond 12 months, no problem. If it's within 12 months, you do want to calculate to make sure that second loan is the appropriate amount. Good question, Marianne. Jackie, my husband and I are under one trust, but have individual bank accounts. He has $300,000 in his account. I have $20,000 in my account. Can we each take out $50,000 participant loan from his bank account? Great question, Jackie. So Jackie, because he has $300,000, he can take out $50,000. You have $20,000, so that means that you can take out $10,000. So it's going to be based on what you have. Great question. RB, if you take out a $50,000 on July 1st, then repay it back in full, can you take out a multiple $50,000 loan even inside of 1 year? So you're going to have to do that calculation. So if it's within that 1 year, you probably can't take it all out. You'll have to look at your repayments. Figuring out how much you can take out is a little complicated. So it all depends on the payments that you're making back. Deborah, if you sell some of your investments and move it back into your IRA checking account, do you need to pay taxes on the investment profits, excuse me? So I think you're talking about, Deborah, are you talking about your trust checking account, not your IRA account? So what's important is if you are using a participant loan and you're doing an investment with that, you can only put what you took for the participant loan back plus the interest back into the trust checking account. Because when you're taking that participant loan, it's no longer your solo 401k investment. So now it's your own personal investment. So you cannot put profits back in. And Deborah, I see an IRA checking account. So you cannot take the participant loan out with an IRA. So if you can clarify on your question. Jackie, can my trust take a loan from his trust account? I actually have more than $20,000, just $20K in cash. The rest is invested. Great, Jackie. Yeah, you could take that full 20. Yep, absolutely. Perfect. Sean, this might be related to Deborah's question. I heard that using a participant loan to invest in real estate can trigger UBIT, the unrelated business income tax. So remember, if you're taking the participant loan, it's now personal funds. It is personal funds. It is no longer your solo 401k funds. So if you're investing money with these personal funds, if there's taxes due, there's taxes due. You know, if you made a large profit, you're still going to have to pay taxes. So work with your CPA. Great question. I know it gets a little confusing. You know, yes, you're taking your 401k funds, but now they're not 401k funds anymore. They're personal funds. When you get them back into your 401k, they're back to being 401k funds, and you can invest from there. Thank you, Sean. So Deborah, let's see here. So it's your 401k. So let me see. So Deborah, when you're selling your investments in your 401k, remember everything's tax deferred. So you're not paying taxes on it. So if you do need to sell some of your investments, I think what you're trying to say is that maybe, you know, if you need to access funds, but you're not liquid, so you need to sell stocks, real estate, whatever you need to sell it, get it into cash. You're not paying the taxes on it. Remember the great thing about the solo 401k, everything is tax deferred. So you're only paying taxes on distributions at retirement age, or if it's your Roth 401k, you're not going to pay any taxes at all. So Deborah, great question. Thank you for the clarification. David, will this be available to rewatch with the Q&A? So yes, you can rewatch it. We'll send you an email after this. Also on our network, we'll have it posted there so you can watch it anytime. Sean, can I use my 401k funds to directly invest in real estate without going through a participant loan? Absolutely. Well, maybe absolutely. If the deal that you want to do is not a prohibited transaction, if you're allowed to do the deal, you know, it's not with anyone that's on that disqualified list, It's just simply an investment with your 401k. Yes, do it with your 401k because all the money you earn is going back into your solo 401k and it's tax deferred. So you really want to use the participant loan when, it's a real estate deal that you're technically not allowed to do in your solo 401k, or, you need funds for something that's not an investment. So awesome question, Sean. Teresa, how do you contribute to your 401k funds? Maybe another class? Yes, we can absolutely do another class. Also, Teresa, post it to the network or send us an email at support@solo401k.com. I know we have a great contribution webinar in one of our knowledge bases. I know if you go to solo401k.net, go to past events, there's a mini contribution webinar there that Rachel did. So check it out, Teresa. There's a lot of action going on in the chat box. Okay, Jackie, can I borrow $30,000 from my husband's balance of our trust so that I too can borrow $50,000? My balance of the trust would then pay his balance of the trust. So unfortunately, Jackie, you cannot borrow from your husband's balance. But great question. It's good to let everyone know that. So thank you, Jackie. So from Mary Ann, can I put personal funds, not funds from another IRA, into my solo 401k? So there's two ways to fund your solo 401k. It's with rollovers and new contributions. So are these personal funds? Are they new contributions based on your business earnings? You can't just put any kind of funds in there. So it would either have to be, a traditional IRA, previous 401k, not a Roth IRA. So it depends when you say personal funds. Are they funds from your business earnings, the one that's sponsoring the solo 401k? The only way you're putting personal funds back in is if you're taking that participant loan. Technically, now it's personal funds, and then you're putting it back in. So that you're allowed to do. Thank you, Marianne. Anthony, can you only have 2 loans in a 1-year period? If the sum of all loans is less than 50K, you could have more than 2. You could have 3, 4, 5, a million, maybe not a million. No, you could have more than 2 loans. You just want to make sure you're not going over that 50K. So good question, Anthony. See if there's any more questions. We have Rachel jumping in here helping out. Thank you, Rachel. So don't forget to join us every Wednesday at 2 p.m. Eastern. I'll chat a little bit while we're waiting maybe for some more questions to come in. Super excited about these webinars. So if there's something that you want to learn about, send us an email, support@solo401k.com. Post it on our network. We love teaching different ways to use your solo 401k, so let us know. Also, we do have our Mondays questions and answers. So that webinar will be every Monday at 6 p.m. Eastern. Bring any questions that you have. Join us live. We love doing that as well. I I think we are good for questions. Oh, thank you guys. Thank you, Anthony, Dale, Teresa, Deborah, everyone. It's been a lot of fun. Deborah, for clarification, you can only use funds to buy a primary residence. So Deborah, the primary residence rule for the participant loan, it just extends it to 15 years. If you're going to use that participant loan for a different home, a second home, then you have 5 years to pay it back. So just to clarify, if it's a primary home and you're using the participant loan on it, it extends to 15 years. If it's for a different residence, it's going to be 5 years. Hope that helps. Okay, everyone, have a great Wednesday. We will see you here next week and maybe on Monday as well. Thank you, guys.